Good morning, everyone, or good afternoon if you're joining us anywhere that isn't the West Coast. Thanks for joining us for this amazing webinar episode. Dive into your inventory data and add substantial profits to your bottom line. Sponsored by HungerRush and brought to you by Restaurateur Connection. My name is Rebecca, and I'm the webinar coordinator for this episode, and I'm excited to bring you some hard-earned insights about the basics of inventory management, including tips on how to get inventory right and how to evaluate your food and pour costs during this very interesting time. I'm really looking forward to talking with Ian Foster. And if you miss any of today's episode, have no fear because this will be recorded. You can access the recording by clicking the link in the chat box that will show up right about now. Up next, and before we go any further, I want to thank our sponsor, HungerRush, and let them know we appreciate having them on. HungerRush is a scalable restaurant technology designed for stellar guest experiences. HungerRush offers a fully integrated restaurant management system that lets the restaurant own the relationship with their customer by mastering operational efficiency, creating awesome guest experiences with ease, and squeezing customer data for every drop of insight. The easy-to-use, highly configurable system includes digital ordering, loyalty and rewards, and delivery management and support, takeout and curbside communications, no contact capabilities, and reporting and management. So you can focus on doing what you love, which is serving great food. Up next, HungerRush also helps restaurants compete in the toughest business on earth. There are a ton of options, loyalty is hard to get, and preferences are changing fast. Their vision is to be the leading restaurant management system built to optimize customer engagement and effectiveness of operations. Of course, their mission is to empower restaurants with technology that showcases and improves their guest experience. So a plethora of resources from HungerRush. And thanks, HungerRush, for helping us make this happen today. Up next, and before we go any further, I want to make a note here that please feel free to ask questions during today's session. You could do so by selecting on the questions panel on the right side of your screen. My lovely colleague Tom will be fielding your questions today. He'll be happy to answer any questions you might have, so pull up the questions panel and say hello to let him know that you're listening. We will also be having a Q&A at the end of our presentation, so stay tuned for even more fresh insights from Ian. Lastly, if you have any audio issues during today's presentation, you may wish to choose to dial in by phone. You can do so by selecting the More button in the upper right portion of your screen, and then select the Switch to Phone option. Up next, and what we're all here for today, I'm talking to Ian Foster from Sculpture Hospitality. Ian joined Sculpture Hospitality in 1991 and has spent over 3 decades helping hundreds of his clients eliminate overpouring, misringing, and theft from their bar operations. He has written extensively about improving bar profitability for industry publications. Ian is also a publisher of several Sculpture Hospitality ebooks. And of course, I am absolutely thrilled to have him with us today. And without any further ado, Ian, I am going to just pass it over to you. It's your show. Take it away.
Thank you, Rebecca, and thanks everybody for joining us. Today we're going to talk, as I said, about how to dive into your inventory data and hopefully find some ways to add substantial profits to your bottom line. So this is the agenda we're going to cover. First, I'll talk really about why we take inventory at all, a little bit about the basics of inventory control, and then we're going to spend a little time talking about how to analyze your pour cost and your food cost. Then we're going to get into ordering. And then finally, I'm going to talk quite a lot at the end about sort of the advanced way of looking at inventory management. And then, as Rebecca said at the end, I'll answer any questions and we can have a dialogue about this. So let me start with a quick poll. If you could let us know what kind of establishment you operate, whether it's a bar or a full service restaurant or a quick service restaurant, maybe a hotel or other. That'll help a little bit guide where we're going with this. So you'll see the poll pop up on your screen, and then you'll see the results of who's on the call with us. So let me keep moving while we wait for the poll to pop up. All right, first question is, why does anybody take inventory in our business? And there's a number of reasons why you might take inventory, and it's sort of important to know what you're trying to accomplish, which will help you. Once you know what you want to accomplish while you're taking inventory, it sort of guides what practices you should use and what kinds of things you should do. So there's sort of 4 main reasons why people take inventory. A lot of people take inventory just for their balance sheet. really just to give to their accountant. And I think one question that you might want to consider is if that's the only reason you're taking inventory, maybe you don't need to do it at all, or maybe you need to do it less often. I mean, if you're in, most of our clients, their inventory dollars from one month to the next don't change a whole lot. So if you're just trying to get a number for your balance sheet, you don't really, it's not that important if you do it every week or every month or every quarter. However, most people want to get more out of their inventory than just getting a number to their accountant. Cost management is another factor, and that's to get your liquor and food costs. We'll talk a lot more about liquor and food costs later, but of course, those are one of your prime costs. If you know your liquor cost, your food cost, and your labor cost, those are all your controllable costs. The only thing really left is overhead. So that's a very good reason to do inventory, and we'll talk more about that later. The third reason people do inventory, most people take an inventory right before they place their order. So we'll talk about that too. If you're doing it for ordering purposes, you probably need to do your inventory at least every week, and for food, maybe even more often. And then finally, if we're talking about inventory management, and of course, that's really trying to control what's going on inside your bar and get some good information on whether there's problems and things that need attention. So we're going to talk about that towards the end. That's another reason you might take inventory. So let's talk a little bit about the basics of inventory. First, I touched on frequency. If you're doing it just for accounting purposes, you don't need to do it really that often. But if you're doing it to place orders or to actually manage your business, you probably need to do it more often, at least once a month, but almost all our clients take inventory once a week. Another question we get asked a lot is, do I need to count everything? So if it depends again why you're doing it, but for the most part, you do need to count everything. I think the exceptions would be if you're taking a food inventory, for example, and you've got a food prep line. For most of our clients, what's in the prep line really doesn't change. It's always completely stocked up. So you could actually figure out what's in your food prep line and then just count that as, let's say there's $600 in your food prep line. You could count out all the rest of your inventory and say, just add $600 for the prep. The other question, of course, is what about condiments? What about bitters in your bar? I think the big question to ask is it material? Is it going to change anything? Are you going to garner any more information if you count bitters? We have some clients that want us to weigh their bitters. We have other clients that don't even count bitters. So the difference is in the one client that wants us to weigh their bitters, they're a craft cocktail bar. They want all of their cocktails completely balanced with the right flavor profile. So for them, by having us weigh their bitters, they know whether their bartenders are pouring the right amount of bitters into different drinks. So for them, it is material. For most people, it probably isn't. Here's a few tips for you. We found in our 30 plus years of doing this that if you separate your full counts by shelf, and then you can easily double check your count, you're going to make fewer mistakes. So let me just explain that a little bit more. You're in your stock room, you've got, say, 5 shelves. What we do is when we count the bottles on shelf 1, at the end, we add up how many bottles in total we count. So there's 5 Grey Gooses, 3 Smirnoffs, 2 Cazadores, etc. You add them all up and there's 43 bottles on the shelf. Then you just go into your 4, 5, all the way down. If there's 43 in your double check, you haven't missed anything or counted something twice. So that's one really good way to make sure, or to help anyway, to make sure that your numbers are accurate. The other thing that our clients like is to have a way to scan a bottle using the barcode rather than searching for it is much faster, or having your inventory method set up sheet to shelf. So when you go into that shelf 1 and you click shelf 1 on your app, or you have it set up on a spreadsheet, the shelf 1 actually lists what's there. So you can just go left to right, 3 Grey Gooses, 2 Smirnoffs, 4 Cazadores, and it's in the order you're counting it, or makes your inventory much quicker. And again, makes it less likely you'll miss something. Beer bottles are tough to count. There's so many of them. If they're in cases, it's pretty easy. The hardest thing with beer bottles is if they're in a reach-in cooler. Those big chest coolers, like you see in a lot of bars. And so what we do there is before we count that cooler, actually the very first time we're going to count the cooler, we fill it all up and count how many bottles fit in that cooler. How many Bud Lights, how many Coronas, how many Stellas. And then what we do before we count it is we just top it up to a certain line so that everything's full. And we already know that there's 143 Bud Lights and 80 Coronas in that cooler. We don't actually have to pull them out and count them. So that's another little tip. Really same principle for your prep area. Stock it up before count. You already know how much inventory is there when it's full. You don't need to actually pull it out and weigh it and count it. We'll talk a little later about a counting app. There's lots of counting apps out there. We have one. There's Partender. There's a whole bunch. That will significantly speed up your inventory. For one thing, you really only need one person to do the inventory. You don't need one person, calling out to the second person 3.4 bottles of Crown Royal, and the other person writes it down. You also save time by not having to do any data entry at the end. You can, if it's a good app, you can just upload the inventory counts to a spreadsheet or to whatever program you use to manage it. But I'll talk about that briefly a little bit later. I think I touched on this a little bit. There's two ways to account for open bottles. I'm talking about liquor here right now. One is to tent them. So that's the most common way. People pick up a bottle of Tanqueray and they say it's 0.3. Or you can weigh them, and that's how our system works, is by weighing the bottles. If you're just doing a month-end inventory, you don't need to weigh them. The accuracy you get from weighing it doesn't really help. It's nice, but it's not going to make any material difference to your accounting. But if you're trying to identify things like overpouring, drinks that aren't getting run up, then tenting doesn't really work very well, because there's clearly a 10% margin of error, which means that even if you tent the bottle perfectly, you're going to be out by 3.38 ounces on a liter bottle, because you can only be accurate within a tenth when you're tenting. And if let's say there's 3/10 in a bottle, but when you're inventorying it, you think there's 4/10 in a bottle, which is easy to do, potentially you're out over 6.5 ounces. So it's impossible to identify something like this. Here we are with Tanqueray, where we know they sold 2 ounces, but they poured 3.43 ounces. So we can see here that there's an overpour, 41% overpour. It'd be impossible to identify that if you were tenthing the bottle instead of weighing it. Okay, let's move on to some meatier topics, starting with how to analyze your pour cost and your food cost. Most operators in our industry spend a lot of time analyzing and looking at their pour cost and their food cost. And for those of you who aren't doing that, it's a pretty simple calculation. You take your previous inventory, say June 1st, you add your purchases, say for the month of June, and then you take your ending inventory, let's say June 30th. So that'll give you the amount that you used overall in the month of June. And then we just divide it by the amount of dollars you collected, how much you sold the inventory for, to give you a cost, a pour cost or a food cost in this case. So let's look at a quick example. I know this is a lot of numbers. If you counted, let's say on May 1st, $7,000, that goes here. And then if you, during the month of May, let's say you purchased $11,000, that goes here. And then at the end of May, or June 1st in the morning, let's say you do another inventory count, and now there's $8,000, that goes here. So if we do the math here, 7,000 plus 11,000 minus 8,000, there's $10,000 in inventory usage in the month of May. And then all we need to do there next is just divide that, let me erase this, divide that by the sales, $40,000. So $10,000 minus $40,000, this bar would have a 25% pour cost if it was alcohol, food cost if it was food. So that's a pretty staple metric that almost everybody, not everybody, but almost everybody in the industry looks at pretty regularly, usually once a month. The question though that I get asked all the time is, look, I'm doing my month-end inventories, and the problem that we have is that our clients will tell us our costs bounce around all the time, from 19 to 23.2 to 17.6. Then we had a couple of months where it made sense, and then it dropped all the way down to 15.2, and then it went too high again. That's a constant frustration. So let me ask another quick poll. How many of you have that problem with seeing your poor cost jumping around from one month to another? Just let us know in the poll really quick. Do you have that problem? Just click yes. If you do have the problem, but it's really only every now and again, it's not really a big deal, say yes, but not very often. And if you never have that problem, maybe click on never. And we'll take a look at that. All right, while we're doing that, let me move on. Talk about why your poor cost or your food cost might jump around like that, because it's very frustrating. You don't know whether you can trust the number. The number one reason why you're going to get that fluctuation is that simply somebody's miscounted something. One of a bar owner I talked to just recently was asking me about this. We started to look at their numbers, and we found that they had counted a bottle of Hennessy VS Cognac, but by accident when it was really a case. So they just written one instead of one case, one bottle. And so that's going to have a material impact on their forecast. You know, there's $600 worth of inventory that they haven't counted. That's going to make a big difference. And then what happens is the following month you do count it, but there's no purchase for it. So that forecast was too high one month and then too low the next. So miscounting is a big factor. Another one is if you're missing an invoice. We see this all the time. You run your inventory at the end of the month, you do the calculations, and let's say your liquor cost comes in at 9%. And that doesn't make any sense. How could your liquor cost be that low? And what we find if we dig into it a little more is that there was an invoice from a liquor vendor that somebody misplaced, and it never got accounted for when calculating that liquor cost. So just to go back, if this purchase number here of $11,000, if we're missing an invoice for $3,000, you could see how that would completely change this calculation, give you the wrong number. All right, we'll move back to where I was. Having incorrect costs set up in whatever way you're tracking the inventory. You know, you're counting everything, and then you've got, let's say you've got Remy Martin XO Cognac in your extensions. You have 10 bottles of it, let's say, and you've got it in your extensions at $200 a bottle. So you should have $2,000 in inventory, but you don't notice that the purchase price has gone up significantly over the last year and you haven't updated it. That's going to have an impact. If you buy another bottle at $250, but let's make it real easy. You buy one bottle at $250, you count the bottle at $200, there's a mismatch. That's going to skew your pour costs as well. Here's something that nobody really likes to talk about, but it's a factor, is that if somebody stole some inventory, then that's going to throw your pour cost off, or your food cost. And then I guess finally, this is an important one people don't think about, is your product mix will change. Will also throw off your analysis of your pour cost or your food cost. And what I mean by that, you can see here on this, this is from one of our clients. Every product you sell has a different theoretical or ideal pour cost. Same in food. You know, in food, pasta has a very low food cost and steaks have a pretty high food cost. And in alcohol, you can see here that if you sell a vodka tonic or a margarita, your ideal food cost, pour cost is going to be under 10%. And of course, it depends on your pricing and what you paid for the product, but generally, your well products, like you pour in a vodka tonic or margarita, have very low pour costs. And then your more premium products like Grey Goose or Glenfiddich or some of your mixed drinks are going to have a much higher pour cost. And here's the issue with this. Whoops. Sorry, I clicked the wrong button. Here's the issue with this is that you can't control what your customers order. So the product mix is going to change. And you can imagine if your bar is in Ohio and it's the middle of summer, you're going to sell a lot of margaritas and not really as many orders of Baileys and coffee, for example, or Grand Marnier. However, that changes in the winter. You're going to sell fewer margaritas and more Grand Marnier, more Baileys and coffee. And at Christmas, you're going to sell more champagne. And so what that's going to do, it's going to make your pour cost overall change. If you're selling items with a lower ideal pour cost, like a margarita, and you're selling lots and lots of those, your pour cost is going to tend to be lower than in a different month if you sold lots and lots of Grey Goose and lots of Dom Perignon and lots of high-end, single malt scotches. That's going to naturally skew your pour cost higher. Those are some of the factors, these factors that I just talked about, that make your pour cost jump around. The first three are going to have a much bigger impact than the last two, but they're all going to affect how your pour cost and food cost look. So that naturally brings up probably the number one question that I'm asked anytime I'm talking to a potential client, and that's, what is a good food cost? What is a good pour cost? And most people in the industry think that if you run a liquor cost of, say, 20%, you're doing amazingly well. If you're running 18%, then everyone should look to your bar as really one of the best run bars. And food costs, somewhere, depending on your concept, 30 to 35% is sort of considered to be a good food cost to run. However, the reality is a lot more complicated than that. In fact, the premise of the question itself is a problem for our industry. Let me show you an example that'll help you understand what I mean. Here's a real client of ours when we first started talking to them, before they hired us and before they were using our inventory control. Their pour cost on liquor was pretty consistent. It was anywhere between 18.6 and 19.7 month in and month out. So they were pretty happy that the average was, let's say, 19.5%. That looked great to them. And they were pretty pleased, and they didn't think that they had any real issues in their bar that would cost them money. And I think most of us would look at that and say, that does look pretty good. It's consistent and it's below 20%. And for liquor costs, that looks pretty good. However, we came in and did some inventories for them, much more sophisticated inventories where we match up the usage and sales. Doing that kind of analysis, which I'll talk about later, can uncover overpouring and theft and things like that. And what we found when we reran their numbers is that they should have been way down here. Let me get my pen working. They should have been between 13.5 and 14.5%, even though they were running 19.5%. That sounds a little weird. How could you run a pour cost this low? But this was a hotel in Hawaii, actually, where they sold, I think, 800 Mai Tais, poolside Mai Tais, every single week. And Mai Tais are well run in some mixer. And so they were selling them for, I think, $8.50. So their pour cost on each Mai Tai was about 8%, because they were selling something that cost them a very small amount of money for, quite a large amount of money. But it's a hotel in Hawaii. Nobody's complaining about the price. Everyone's too much enjoying themselves too much. But the point here is that if you should be running 14.15 and you're running 19.20, all of a sudden 19.20 doesn't look so good anymore. And these numbers themselves aren't that important. You could be running 24.25 and you should be at 21.22, and we have the same problem. The key here is knowing what this ideal or theoretical cost is. In other words, what should your cost be if you didn't have any? Actually, let me flip to the next page. The ideal or theoretical is, what would your pour cost or your food cost be if there was no waste, no theft, no overpouring, no overportioning? In other words, if everything that was rung up was poured or portioned perfectly, what would your food cost or pour cost do or be? Sorry, and that theoretical number is a very important number. Without that, you don't really know whether your pour costs or food costs are good. Again, I said at the beginning that that's the number one question we get asked: what should my pour cost be? And it depends on so many things: your product mix, whether there's any overpouring or theft or overportioning, what you sell the drinks or the food at. All those factors really make it a difference. So it's critical to know your ideal or theoretical pour cost or food cost. All right, let's keep going here. So let me show you what it would look like if you wanted to calculate your ideal, in this case, pour cost. This is the same exact example I showed you earlier, where they had $10,000 in cost. But let's say that they found out that they had $1,000 in waste, theft, overpouring during the month of May, which wouldn't be, I know it's a lot of money, but that wouldn't be unusual. So the way we would work that out is we'd take that $1,000 off of the $10,000 in usage that we calculated. And then we take that new result of $9,000 and we divide that by the sales to come out with a ideal or theoretical cost of 22.5%. Let me erase that. There you go. So then we compare that to our ideal, to our actual pour cost. So if our ideal is 22.5, but our actual is 25, and we divide one by the other, we come up with a 90%, I guess, efficiency rating, for lack of a better word, which means really there's 10% of you're 10% off your ideal. You know, if you're 90%, there's 10% gap there. That 10% of money you're losing. So that's a very, very helpful way to look at how your bar or your restaurant is performing. And we find that on the alcohol side, your actual pour cost should be within 1/2 of 1% of your ideal pour cost. So if your ideal pour cost is 22.5%, then your actual pour cost at the end of the month shouldn't be any higher than 23. If it is, alarm bell should be going off and you should be concerned and trying to figure out what's going on. But if your ideal is 22.5 and you're running at 22.8, that's pretty darn good. It's never going to be perfect. You know, our industry is not an exact scientist. We're not scientists using beakers to pour liquids, and same on the food side. So on alcohol, we found over 35 years of being in business that within 1/2 of 1% is a really good target. Let me shift gears a little bit and talk about ordering. Ordering is probably one of the things that is the most important benefits of taking inventory. Let me talk first about static versus dynamic PARs. Actually, let me back up and talk about what PARs even are. Most of us in the industry, when we're trying to figure out how much Baileys to order, how many bottles of Baileys to order, we'll first establish a PAR for Baileys. So usually what that looks like is your bar manager will sort of monitor how much Baileys you're ordering week in and week out, and get a kind of a feel for how much Baileys you need to have on hand. So let's say that most weeks you're going through a couple of bottles of Baileys. Most bar managers will say we should set the PAR at 3 because we don't want to run out of Baileys, so 3 is a good PAR. And then when the manager goes to place an order, they'll walk into the stock room, they'll have a spreadsheet or something that says the PAR on Baileys is 3. They'll look at the Baileys in the stockroom shelf, and let's say there's 4. They know they don't need to order Baileys. On the other hand, if there's 1, they need to PAR up to 3. They need to order 2 bottles of Baileys, and that tends to work okay. The problem with setting a dynamic, that's a static PAR, where you set the PAR and then you just use that PAR from now on. That's the way that almost everybody handles their ordering in the industry, and the same on the food. You know, you walk into your freezer and you've got a box of chicken wings and you know that the PAR is 2 boxes, you know you need to order 1 more box. The problem with setting a static PAR, well, there's a couple. One is it's an awful lot of work to figure out what the PAR should be on every product. The second problem with it is that you know, different products become more and less popular. I talked about in the winter selling more margaritas, in the summer selling more margaritas, and I'll give an example of that. But even food trends change. You know, years ago, I remember that jalapeno poppers were really big. So if you set your PAR in jalapeno poppers 25 years ago, you might have cited it 2 cases. But now almost nobody sells jalapeno poppers, at least in San Diego where I live. So if you still had a PAR of 2 on your jalapeno poppers, you probably have 2 boxes sitting in your freezer that have been there for a long, long time. And then when you finally get rid of one, instead of letting it run down because you don't need any, or you only need a small amount, if you have a static PAR, you order another box. And And of course, the opposite's true. If something becomes more popular and you have a par of 2, and now you're selling 3 or 4 cases, let's say a week, then you'll keep running out of it until eventually you go, oh, I better change the par. But in the meantime, you've caused a bunch of disruption because you've run out of it. Dynamic pars are a much, much better way to set a par. And the idea here is, again, we'll use tequila as an example, because in the summer, when you're selling more margaritas, you're going to use more tequila. And what we'd like ideally is for that par to go up as your usage goes up automatically. And then on the other side, as your tequila usage goes down and as the fall comes and in winter, we would expect the par to also drop as well. That's really the holy grail of setting pars, is to have them adjust to exactly what you're using each and every week. Talk about a couple other things to do with ordering. Case lots. If your state gives a discount on alcohol for case lots, you should probably order by the case if you use 2 bottles or more a week. Receiving deliveries. This is sort of bar management 101. Always you should count the order, and then if your manager have your manager sign and date it. Just yesterday, one of our clients got shorted a bottle of brandy. We didn't know they'd been shorted until we did the inventory count, matched up the usage and sales, and found out they were missing it. One more thing that's really interesting. There's a company that we integrate with called Provi. They have a really cool ordering platform that I'll quickly explain. For our clients, when they log on to Provi, in this column here under suggested, it gives them the suggested order based on our dynamic pars, and then they set the order. They can make it higher or lower. And what happens is, this is the cool part. So here we go. The cool part is Provi automatically takes those orders, figures out which orders belong to which vendors. Provi sends them automatically. The rep automatically gets the order, and as you can see here, there's a time-stamped tracking of each order, when the rep got it, when they signed off on it. The rep also on the same platform lets you know if they're out of stock on something. And that's a really cool, I think, really useful option. Provi's free. I highly recommend it. Okay, moving on. Let's talk about advanced inventory management. There's a lot to gain from better inventory. In our 35 years, we found that in the bar, the losses are generally somewhere between 20 and 30% from things like overpouring and drinks not getting rung up. If we can eliminate that, we're going to see generally our clients see their profits increase by about 10% of their sales. So if your sales are 20 grand a month and you're able to control those costs, you can expect $2,000 to float directly to your bottom line. If your sales are 30 grand, you can expect $3,000 to float to your bottom line. And then of course, better inventory means better and more accurate ordering as well, as we talked about a minute ago. Okay, so we just talked about this. So let's get into this in a little more detail. So what if your pour cost is too high? And consistently, you know, your ideal is at 22.5 and you're running 27. What do you do next? Well, the gold standard is a way to match up the usage to the sales. For one thing, that helps you spot and identify miscounts. If all of a sudden you're missing a case of brandy, like my client was yesterday, you can go recount it and then start trying to figure out why you're missing a case of brandy. In this case, it was shorted on the delivery. But the other thing that matching up usage and sales does is it allows you to identify shrinkage. Here's an example of the kind of information you get when you do this unit, this matching up of usage to sales. Here we can see that they used 2.45 ounces of Glenfiddich and they sold 1.5. So we know that they're missing about just a little less than an ounce of Glenfiddich. Now, nobody stole it. It's not even a full drink, but it's a pretty hefty overpour, 39%. Or we can see Jack Daniel's, much bigger numbers here, used 42, sold 34, missing 8 ounces, 19%. Or on draft beer, we can see 1,800 ounces of Bud Draft used, but only 1,500 rung up, 300 ounces missing, 20%. And you can imagine that with this kind of information, how you can go to your bartenders, or for food inventory, you can go to your kitchen staff and show them where the problems lie, and that resonates with people. Instead of just saying our pour cost is too high this month, let's get this under control. when they can see this kind of information, that's everyone knows what's going on. And for example, with the Glenfiddich, your bartenders can easily see that they got to be more careful on their pours. They don't overpour it. If you've got a great POS system like Hunger Rush, you can actually then drill down to figure out, okay, well, who rang up this drink that was overpoured? And we can see here that it was rung up by Carla at 11:45 p.m. on this check number. So that you don't need to do that very often, but when you do that, that's pretty powerful information to have. Again, what I'm talking about on liquor, and beer and wine translates exactly to food as well. You can do the same kind of analysis on ground beef or bacon or chicken wings by matching up the usage to the sales. So what do you need to do a unit analysis and matching up usage and sales? Well, most of us can do this for beer bottles right now. You can go and count your Corona and then match it up to what was sold, and you can find out that there's, in this case, 6 bottles of Corona missing. I've rarely seen any bars or restaurants actually do this, but it's pretty easy to do it on Corona. It's pretty easy to do it on ribeye steaks. It's pretty easy to do it on scallops. It's much, much harder to do it on a lot of other products. So for liquor, wine, draft, and food, you need a few things. You need a POS system like Hunger Rush. You need an inventory software program. At this point, now we're talking about you need to invest in some technology to be able to track this kind of thing. And the inventory software needs to allow you to have a recipe for every item that's rung into your POS system. So a hamburger, you need to be able to set up the recipe as 1 bun, 1 meat patty, a half an ounce of ketchup, etc. And you need to be able to enter detailed purchases. So when you order, let's say a liquor order, you need to be able to enter the order as 3 bottles of Bailey's, 2 bottles of Tanqueray were purchased. Having an inventory software program has a lot of benefits to it. It allows you to identify and eliminate the shrinkage we've been talking about, the overpouring and theft, making you more money as a result. It also helps you run a much better order. I talked about the dynamic versus static bars. A good inventory software program will give you that kind of information. Gives you more reliable accounting data, because if you are shorted a bottle of brandy, like my client was yesterday, that you can identify that, fix it, and get a credit for it. And then your accounting is not thrown out. You don't have a huge pour cost this month because of something like that happening. Without an inventory software program, you wouldn't even know. You just look at your pour cost, it would be too high, and there's really no way of drilling down from there. And then finally, a good inventory software program will give you really good insight and visibility into the profitability of each item on your menu. What's your contribution margin on a hamburger? If tomatoes have skyrocketed in price this summer, and now instead of making, let's say, a 75% gross margin on a hamburger, you're only making 30% gross margin, it'd be super helpful to have that information, so you can either adjust what you're putting on your hamburger or change the price or find some other thing to do. So here's the kind of reporting you can get from this happens to be our software, is that it tracks when a cost changes happen. So you can imagine that it would really be nice to know when some of your costs go way up, so you can again adjust. So here we can see, for example, that Elysian Space Dust went up by $39 a keg on the last purchase. Let me change this. Here we go. The really cool thing on food is you can derive fully costed recipes from a good inventory software program. So for example, here on the sweet and sour chicken, we can see that the ingredients are based on yielded product, which I'll talk about in 1 minute, but also include everything you include when somebody orders sweet and sour chicken, including the rice. And from that information, you can find out exactly what your cost is to serve sweet and sour chicken, what you sell it for, and then what your food cost is. That's just, sort of the gold standard of information for understanding where you're making money, where you're not making enough money. And again, when price fluctuations occur and this number jumps from 15 to 20, you can monitor that as well and take steps to manage, your profitability. So here's a few things to look for in inventory software. If you're looking at that, one is you want variance reporting, which is what I've been talking about, ability to match up usage to sales. I strongly recommend that whatever software you look at includes accounting app. Here's ours. You can see here that we just scan the barcodes on the liquor and weigh the bottles. It's very, very fast. You can scan and count everything very quickly and do double checks all the way through. Let me close this. I'd suggest you find something that supports a weighed inventory if you're looking at doing inventories for alcohol. You don't really need that for food, but for alcohol you do. It should have a large database so that you don't have to add every single product when you first start using it. Probably, I've got a couple bolded here because they're really, really important. Running an inventory software program, no matter which one you use, is challenging, especially if you do the setup incorrectly. So it's critical you get help with that setup, that when you're doing the recipes and setting up the initial costs, that there's somebody that can guide you through that process, make sure it's set up right. Because if you don't set it up right, we've got the garbage in, garbage out problem in the long term. And there's no use having an inventory software program if you don't know if you can trust the numbers. Similarly, you want to have some training and I think critically support somebody you can call or somebody that'll help you if something doesn't make sense or you're trying to figure out why you have a huge shortage on, chicken wings. It's nice also to have different service options. This isn't an advertisement for our company, but we have 3 options. 1, we can actually come in and do the inventory for you. 2, your manager can do the inventory. We can do all the data entry and analysis and all the back end work. Or 3, you can do everything yourself. Having different options helps. A really important factor is to have functionality for, I should say, prep items, not pre-items, and batches. Prep items and batches, it's critical that the inventory software accounts for those correctly. So a prep item, for example, for a shrimp or crab dip, here we set up a prep item here in the software that says how much shrimp, how much crab meat, how much milk, how much heavy cream. And so when you go to count the batch, you've got a little container of shrimp crab dip. You just say, oh, there's 3 shrimp crab dips. That's it. You're finished. And the software automatically knows how many carrots are in there, how much onions, how much salt. I mean, that's going overboard, but how much shrimp, etc., without you having to do all this manual calculation. One last thing I want to talk about before we turn to questions is the impact of yield on food inventory. All right, so yield is you buy something like, in this case, bacon, and you buy, a pack of bacon. Let's say you buy a pound of bacon. You're not going to be able to serve your customers a pound because when you cook bacon, a lot of the moisture and fat and water gets cooked out of that bacon. So when you actually, let's say you take 1 pound of bacon and then cook it and then weigh it again, it doesn't weigh a pound anymore. It weighs a lot less. So if you don't take that into account, right, and you serve 0.6 ounces of bacon and you don't account for yield, you think you have a 12% food cost because you think you're getting, you're working out the cost of 0.6 ounces of bacon, but that's not really the way it works. When you cook out the fat and all that, when you cook bacon, to serve 0.6 ounces, you actually have to start with a lot more raw bacon. So the food cost on that bacon that we talked about for the same amount, for the same 0.6 ounces, if you do it properly and use a yielded bacon, your food cost can be 42%. So you can see it makes a tremendous difference. If I'm trying to cost out a menu and I think my food cost on the bacon part is 12%, it's great. But if it's really 42%, that means I'm not making very much money on, for example, by charging somebody $1.50 to add 0.6 ounces of bacon to a hamburger. I think I'm making great money because I haven't yielded it. But if I do it properly, and in the software program, this is what it should be able to do, then you realize, no, I need to charge more than $1.50 unless I'm okay with a 42% food cost on that extra bacon on a hamburger. Okay, I've gone through this pretty quickly. Rebecca, let me turn this back over to you and see if anybody has any questions. I'm happy to answer.
Absolutely. Thank you so much, Ian. Before we dive into questions, I just want to say I understand if you need to run, but remember we are recording this session. So if you need to run at any moment, no worries. We'll make sure to send it on over to you within 48 hours. Also want to let everyone know that now is the time to get your answers straight from the source. Ian is with us live. So make sure to ask those questions. I know it was a lot of information, amazing information. The whole time I was just like, oh my gosh, these costs. How would I do this so fast? But if you have any questions, just let Ian know here. All right, so let's dive in here. Actually, before we do that, I want to show the poll results with you real quick, Ian, to show you where everybody's at.
Great. Thanks.
So this is, yeah, no worries. So this is the first one about where everybody's from. So full service restaurant was in the lead, 50%. But hotel was like right behind it. So not too shabby. And the second poll here, the answers for that is, do you see cost jumping around too much from month to month? Yes, but not very often. Yes, and then a couple nevers. So mixing it up a little bit here. Alrighty, let's jump into those questions now. This will just be 1 second while I grab this. The first question, this is from Sasha. And this question in particular is about the liquor shrinkage. And she's saying, we are experiencing liquor shrinkage. She says, I'm not sure if it's due to the overturn in staff or just because everything's been up and down. But I'm wondering if you have some quick tips on how to determine the liquor shrinkage. I know you kind of went over that a little bit. And maybe letting me know what are the best practices on how to avoid this.
That's a great question, Sasha. You know, it's funny, well, not funny, it's tragic a little bit, is that we're seeing shrinkage levels now coming out of COVID much higher than they were prior to COVID. I'm not sure exactly why that is, but that's what we're seeing. So I guess the number one best practice is to find a way to identify that shrinkage. So if you already know that your bartenders are routinely overpouring, let's say single malt scotches, and you've got some data to show them, then step one is to have a meeting with your team and just show them and say, hey, look, help me understand it. Why are we overpouring Glenfiddich? Or why are we, let's say things aren't getting rung up? You know, look, we sold 24 bottles of Corona yesterday, but we actually used 29. If you can show them that kind of information, just ask them to help you understand it. Two things will happen there. One is they'll understand that you're on top of it, that you see what's happening. And two, as a result of that, they'll know that if they don't, you know, if they're not a little more careful, that there's going to be consequences to it. That's sort of the second part of this, is making sure there are consequences to it. I've got a whole other seminar that we just talk about how to fix these issues. So in the like 30 seconds left in this answering your question, I think the key is to make sure that you've provided the right training. You're watching the bartenders pour, not to catch them doing something, but if you see them not doing something right, not pouring carefully, that as a manager you can help them get better. So a little coaching. But if none of those things are working and they're still not being careful with their pours or not bringing things up, next step is probably to give them a written warning, and then moving eventually on to suspension, and then ultimately got to find a bartender. Anyway, let me end that there because I could go on about that for hours. And you're welcome to call me or reach out to me on LinkedIn or email, and I'd be happy to talk to you about that anytime, Sasha.
Excellent. And Sasha, if any follow-ups, just let us know in the questions panel. This goes for anybody else on the call today. Ian's information is up here. So if you have anything that you want to take offline, or, you know, like Ian is a plethora of information, and I think we can honestly do like 4 or 5 parts on this. So just reach out to him.
Rebecca to be this excited about inventories.
No, I think it's fantastic. This is what everyone's here for. And actually, right after that question, the questions panel just blossomed. Wow, we have a lot of people that want to hear what you have to say, Ian. The next question, this is from Renee, and this is a little bit of a two-parter. Renee is saying, hi, I think I missed the part of what food cost percentage should be for quick service. I thought I heard bar numbers, but I have a quick service deli. And then she said, the above question on quick serve food costs would include food given away for due to popular loyalty rewards programs.
Right. Those are good questions, Renee. Let me take the second one first. When you're working out your ideal food cost, if that's what you're trying to do, you need to account for any authorized giveaways. So we do more work with alcohol inventories so far than we're also just started offering food inventories. So I'm really more familiar with the bar end of things. So let me give you an example. If from all of our clients, we encourage them to have a very liberal comp policy. When you have guests coming in and you want to make sure that they're well looked after, some guests you want to make sure they feel that love. We don't want bartenders over pouring because you can't control it. You don't know how much they're doing of it. You have no way to track it. So it's much better to comp the customer. And I think the same thing applies to food. It sounds like you're doing that already. But the key is that's not that's not like a loss. That's a business decision and should be factored in. So it doesn't make your it doesn't widen the gap between your ideal and actual food cost. Your first question is what should your ideal or what should your food cost be for a quick service restaurant? And that's really the key to the whole thing, is that there's no way to answer that without doing an analysis of what you sell, what your product mix is, what you pay for things, what you sell things for. Just to give you a really dumb example, if I compare a burger chain quick service to a pasta or a taco place quick service, the burger chain is probably going to have slightly higher costs because their ingredients cost a little more. Now, their sales prices are a little higher too, but it becomes very complicated. So really, you need to work out the ideal food cost for your establishment. And if I gave you a number, it would be malpractice, I think. But that's a good question.
Excellent. Thank you so much. And Renee, if you have any follow-ups, just let us know in the questions panel. Ian is here to help. The next question is from Bernard, and this is a clarification question. Bernard is asking about your calculating idea again versus theoretical.
Right. Let me move back. Let me just go over that one more time here. Hang on. Sorry, I hope I'm not making you all dizzy. Okay.
Just gotta buckle up. No worries.
So again, what we're trying to do here, as Bernard pointed out, is everyone can easily work out their actual pour cost or food cost. What we'd like to know is what should that number be, which really goes back to Renee's question. But Bernard's asked it in a slightly different way. So how do we calculate this number here? So let me go back to the real calculation that I showed you. So here we go. So let's say these are your numbers when you calculate your actual pour cost, right? So we know that when we add the May starting inventory, we add purchases to that, and then we subtract the ending inventory. We know that there's $7,000 used, and then we divide that by, oh, sorry, I did that wrong. The $7,000 plus the 11 minus the 8, there's $10,000 used. We know that is your actual number. And let's say that we have a way of tracking shrinkage, and we know that there's $1,000 in shrinkage, right? That is not accounted for. That things are getting not rung up, or they're getting over poured, or if it's food, they're getting over portioned. So what we do is we take that $1,000 off the $10,000. So that leaves us with $9,000. That's how much you should have used if there hadn't been any shrinkage. If that $1,000 hadn't been missing, if you had no losses, you would have had a usage of 9,000. Then we divide that by the 40, and I think that came out to 22.5. Let me just pull up my calculator here. That's how you figure out your ideal. 9 divided by 40. Yeah, 22. That would equal 22.5%. So I hope that answers your question, Bernard. You really just take that shrinkage out of this. I got too many numbers. I got too many drawings in here now. You take that shrinkage out of this $10,000. And remember, the $10,000 comes from here. So I hope that answers the question. Again, I'm happy to talk about this in a lot more detail if you want to contact me.
Excellent. Thanks so much. I actually really appreciate that as well. I was like, oh, wow, yeah, that makes sense. So thanks for going over that again, Ian. The next question we have here is from Tom, and this is more of a, I guess, hear your commentary. But Tom says, I've taken a slightly different path. My accounting allows me to create a monthly P&L for major categories of the things I sell, like food, liquor, beer, and wine. I feel that this gives me some visibility, and it's just wondering if you have a comment about that.
Yeah, so Tom, you're one step ahead of most people who just work out. For example, in this client, they just knew their overall alcohol costs, so their pour cost, or someone that just knew their food cost overall. And if it's too high, where do you go next? You're doing really, I think a smart thing is that you're breaking it into categories. So if your overall food cost is too high, you can look at the different categories and say, oh, wait a minute, it's in my dairy. And then you can try and look at dairy and see if you can figure out where the problem lies. Or if on pour cost, if you're looking at a high pour cost, like right here at 23.2, then you can sort of look at all your different components and you can say, oh, you know what the problem is on my draft beer. Draft beer is the problem this month. The only thing that, so I think you're, how do I say this? I think you're doing what you're doing is really smart. It's a good first step, I guess. The problem is, what if you do that and then you realize, oh, it's liquor, my liquor numbers are too high. My pour cost is driven by my liquor numbers are too high. How do you then figure out what the problem is and how to fix it? Or if it's over pouring, how do you don't have any data to go to the next step. So I'd say you're 80% of the way there, but if you want to really drill down and find some more cost savings, that would be the next step. But I think what you're doing is smart.
Excellent. Thank you so much for that, Ian. And Tom, if you have any follow-ups, just let us know. The next question, I'm going to go a little bit faster because we're butting up here. This is from John. Yeah, we're still doing good. There's so many great questions though that I want to get to them. The next question is from John, and this is, can you discuss the role of the contribution margin in the decision making when analyzing the cost percentage? Might you not accept a higher food cost in this if this contribution margin is higher?
Yes, 100%. That's exactly right, John. I'll give you a really good example. We know that, for example, very expensive wines, you're generally going to have a pour cost of maybe 50%. So as opposed to your house wines, you might have a pour cost of 25%. But if you asked me if I owned a bar and you said, well, wouldn't you rather sell $10,000 worth of house wines, or forget the number of dollars, wouldn't you rather sell 10 cases of house wines with a 25% pour cost rather than fewer bottles of Dom Perignon? The answer is no, because even though the pour cost is higher on Dom Perignon, I make a lot more money on Dom Perignon. I would love to sell nothing but Dom Perignon in my bar, very expensive wines and champagnes, and all I had to do was walk that bottle to a table and open it and speak in a French accent, and I would make a big amount of money for selling it. I don't care about my pour cost. I don't feed my family on pour cost. I feed my family on dollars. Same thing in a restaurant. I would much rather sell, a very high end. Let's say I would much rather sell a T-bone steak in a restaurant, even though my food cost might be 40%, than I would like to sell a hamburger with a 25% food cost. So I'm not sure if that's your question was, John, but the important part is the contribution margin, like you say, is how much money do you put in the bank?
That's a really great point, actually. Yeah, to kind of like focus in on that particular part, that how much money are you putting into the bank? Let's see here.
So if we run out of time, anybody can contact me. My email is foster@sculpturehospitality.com. I'm on LinkedIn, etc. Go ahead, Rebecca, if we have time for it.
No worries. That is excellent. I was going to say, if we're running up here on the end of time and you have any additional questions, please make sure to reach out to Ian. He's not only an incredible speaker, but he has an amazing background, of course, in being in hospitality, restaurants, bars, all of that. So definitely don't miss on that opportunity. We actually have only 2 more questions. I'll probably just pose the one and then I'll maybe pose the other one in just a second. But this question I think is interesting, and maybe it's more of like next steps. So this question is from Kenneth, and Kenneth is saying, I really love the video that you have of those employees that were scanning the barcode and weighing it and how fast and efficient it is. However, I'm a little bit worried that during a more busier nights when we open for summer, that our bartenders and managers might not take this into consideration due to the amount of people in the bar. So do you recommend some sort of incentive program, or do you have an idea about how we can incentivize on this?
So I'm going to split your question, Kenneth, into two parts. One is incentive programs. I've got a lot of good ideas. Probably don't have time, but that's more on management incentive. As far as I think the core of your question is that you really can't be taking inventory when you're open, for obvious reasons. And that if you count your Corona at 9 p.m. and there's 43 bottles, by the end of the night, there might only be 33 bottles. So none of our clients and none of our auditors take inventories when the bar is open. I guess the other question is, and maybe I misunderstood you, how do you get people to count after closing is, I mean, hardly anybody wants to do inventory after they've worked a full shift. So almost all our clients and all our auditors work before the bar opens in the morning. I'm not sure if I hit your question the way you wanted me to or not, but let me know if I did.
I think so. He isn't putting anything else in, so it might have just been more of like an offline question, and he'll probably ask a little bit. All right. Well, unfortunately, that's all the time that we have for today. I hope you all enjoyed this webinar as much as I did. Thanks to our sponsor, Hunger Rush, to our incredible speaker, Ian Foster, and all of you for attending. I'm Rebecca, and if you're interested in more thought leadership like this, you can find us on Restaurant Connection on Twitter, as well as on LinkedIn. And of course, make sure to reach out to Ian and check out more from Sculpture Hospitality. Thank you guys so much, and I hope you have a great rest of your day. Bye-bye.
Thanks, Rebecca. Bye, everybody.